Hello everyone and welcome to my channel. In today's session, I'll take you through the latest transfer pricing regulations in UAE, what it contains, its applicability, the documentation requirements, and what we can do right now to be future ready and transfer pricing compliant. So as we all know that the UAE Federal Tax Authority has been gradually introducing various guides and publications to the various aspects covered in the UAE corporate tax law. So on the slide, I have put the various relevant decrees and circulars relevant for transfer pricing. In the most recent publication dated 23rd October 2023, the Federal Tax Authority issued an extensive 140-page transfer pricing guide. This guide, it offers various insights as well as it has a lot of illustrative examples on different aspects of the UAE transfer pricing regime. So, for example, guidance on the application of the arm's length principle, transfer pricing documentation, considerations for specific transactions like financial transactions, intra-group services, intangibles, and cost contribution arrangements, as well as TP audits and risk assessments have been provided in the transfer pricing guide. So essentially, the guide is based on the 2022 OECD transfer pricing guidelines. Though the guide will not be a legally binding document, it will be the primary source of guidance for transfer pricing related matters going forward. And it can be used as an indication of how the FTA will apply the transfer pricing regime. So mainly the taxpayers should rely primarily on the corporate tax law. That is the decree number 47 of 2022. The ministerial decree decision number 97 of 2023, cabinet resolution number 44 of 2020, and the guide for transfer pricing matters involving the UAE. Now, let me briefly explain what is transfer pricing. So, transfer pricing or arm's length principle means that the transactions between related parties and with connected persons needs to be at a similar rate as if they are being undertaken between independent parties. Okay. So, simply put, it means that the transfer price between related parties should not be manipulated to shift the taxable profit base to a related entity or a connected person, which is subject to a lower rate of tax. So the main idea of TP regime is to avoid shifting of tax base to another tax jurisdiction. Now, to give a broad overview, the following articles, which are mentioned on the slide, of the federal decree law, which is the corporate tax law, they deal with transfer pricing provisions. So, for example, Article 1, it gives certain definitions such as related party, connected person, meaning of control, etc. Article 34, it talks about what is arm's length principle. Article 35, it talks about related parties and control. Article 36, it talks about what are payments to connected persons and how are they covered within the ambit of transfer pricing. Article 55, it prescribes certain requirements for transfer pricing documentation. Now coming to arm's length principle. So Article 34 and the transfer pricing guide mentions that arm's length principle means the transactions between related parties and the connected persons should be at a similar price or margin as it would have been for similar transactions between independent or unrelated parties. So let me take a very simple basic example. So say there is A Limited in USA, which is selling 1 kg of apples to its subsidiary B Limited at 100 dirhams per kg. Okay. Now the same apples, same quality of apple, same type of apple is available in the market for 60 dirhams per kg. Now here, in this particular transaction, transfer pricing will kick in. First, A Limited and B Limited, they are related party within the law, within the transfer pricing law. So the transactions, since they are holding an subsidiary, so the transactions between them will attract transfer pricing compliance obligations. And in this example, the price of 60 dirhams per kg, that is the price between independent entities, will be considered as the arm's length price for the tested party transaction between A Limited and B Limited of 100 dirhams per kg. Now, coming to some important aspects that the transfer pricing guide has provided for application of arm's length principle. The guide talks about accurately identifying the transactions subject to transfer pricing, as well as understanding the commercial and financial relations between the transactions. The guide has emphasized on the importance of the functional analysis. So the people who are aware of transfer pricing, I think they know that the functional analysis exercise is one of the critical elements or an underlying basis for determining the arm's length price of controlled transactions, and it is undertaken to identify the economically significant activities performed, assets used, and risks borne by the respective transacting parties. In line with the OECD transfer pricing guidelines, a 6-step framework has been provided in the UAE transfer pricing guide for analyzing the risks under the functional analysis. So while analyzing the risks, the FTA expects taxpayers to undertake thorough functional analysis to determine what risks have been borne, what is the impact of these risks, and which party bears these risks. The guide offers practical guidance to taxpayers by presenting a comprehensive illustration of how to document the functional analysis. Further, after the functional and risk analysis is complete, one needs to undertake a comparability analysis to identify independent comparable providing similar products or services within same economic and market circumstances. While doing so, special considerations have to be kept in mind with regard to market conditions, economic conditions, whether any losses are incurred, etc., etc. And also, as I have also mentioned in the previous slide, that in certain cases, there is a provision that if you are not able to find exact comparables, then you can make certain adjustments for the differences in the comparables and their conditions. Now coming to another important aspect of the transfer pricing regime, which is what is a related party. So Article 35, it defines related party and control. The definitions for related parties and connected persons in the transfer pricing guide are aligned with the definitions noted in Article 35 and 36 of the Corporate Tax Law. The guide offers multiple examples to demonstrate how the definitions of related parties or connected persons may be applied by taxpayers in respect of their operations in the UAE. So broadly speaking, when a legal entity or individual has more than 50% of direct or indirect ownership or control over a taxable person, this falls within the related party definition. The law also defines control as the ability of a person to influence another person. So, as a first step in a transfer pricing analysis, we would need to assess who all are the related parties. Also, we would need to identify the transactions between the related parties, which will have a transfer pricing implication. So, through various illustrations provided in the transfer pricing guide, it becomes clear that the determination of control is not solely reliant on a specified 50% ownership threshold. Instead, control can be established when one person exercises significant influence over another person. Now, as most of us are aware of that the UAE transfer pricing regulations has a very specific provision which provides for disallowance of payments to connected persons if it is not at an arm's length value. So a person will be considered connected to a business if at least one of the following conditions is met. So the conditions are that it is an owner of the business, it is either a director or a key managerial person in the business, or it is a related party of any of the above. Okay, now this point number 3 is very wide. So a relative has been defined as a relative within the 4th degree of kinship or affiliation. So it has the potential, a massive potential to cover a lot of individuals, a lot of relationships within this definition. So the meaning of related parties and the connected persons is very wide and will need to be analyzed on a case-to-case basis for application of transfer pricing provisions. Now coming to an example of control. So this example I have taken from the transfer pricing guide itself. So this example says that company X is a UAE company that is 51% owned by company a UAE company, and 49% by company Y, which is a foreign company. While company A owns a majority interest in company X, the management of day-to-day operations, development of strategies, and formulation of the key market decisions are the functions of company Y. Based on the above, it can be established that company Y has control over company X, even though its shareholding is below 50%. Okay, due to the key role in the market decision. So this becomes very important, this example. It goes on to establish that even if your shareholding is below 50%, by way of your potential to take key market decisions, a company or a person can be said to exercise control over that company. So in this case, both company A and company Y would be considered related parties of company X through ownership and control, respectively. Now coming to the key impact for taxpayers. So the taxpayers must evaluate and assess their relationship with other persons, any natural person or juridical person as defined under Article 1 of the Corporate Tax Law. to determine the applicability of any of the related party or connected persons definitions, either via kinship or ownership or control, and exercise of significant influence, as well as the applicability of the connected persons definitions. It is the responsibility of taxpayers to conduct a self assessment to determine whether a person exercises significant influence, thus potentially classifying that person as a related party. Now, coming to another important aspect, which is TP methods. So, to arrive at the arm's length price, there are 5 methods which are used across the world and also have been prescribed by the federal decree law. They are CUP, RPM, CPM, PSM, and TNMM. So I'm using the short forms. So they are comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, transactional profit split method. Now, the UAE guide, as well as certain other countries such as India, they have also included in their methods, they have also prescribed another method. Now, just to give you a brief idea of what each method entails. So, the CUP method compares the price charged for property or services transferred in a controlled transaction to the price charged in a comparable uncontrolled transaction in comparable circumstances. The cost plus method will consider the direct and indirect costs incurred by a supplier in supplying goods or services in a controlled transaction and applies an appropriate markup to these costs based on the functions performed by the supplier and the profit that would have been earned from an arm's length transaction depending on the market conditions. The transactional net margin method will examine the net profit earned from a controlled transaction relative to an appropriate base, such as the costs, sales, or assets. The resale price method, this is used in cases of resell or distributor kind of functions. So in this, the gross margins earned from that reselling function are compared. The profit split method is applicable in the cases where the related parties engage in highly integrated business operations or where each of the parties to a controlled transaction make unique and valuable contributions or use unique and valuable intangibles in relation to the controlled transactions. So the profits are split on some allocation basis within the group. Now, the guide has also provided that where none of the 5 methods can be applied, then the other method can be considered for the purpose of determination of the arm's length price in line with Article 34(4) of the Corporate Tax Law. However, where an alternative TP method has been used, adequate supporting documentation must be provided explaining the reason for selecting the method, including reasonable, sufficient economical and commercial rationale, as well as clear disclosures of analysis performed in applying the method. So the ones who are aware with transfer pricing regimes across the world, I think the main important, very pertinent point to note for all the professionals, especially the ones who are just starting off in their transfer pricing practice, is the emphasis which is laid on the documentation that is maintained. So whatever position you are taking, whatever method you are using, whatever restructuring exercise you are undertaking, or the way you are paying, say, royalties, you own certain intangibles. So everything needs to be substantiated by a proper documentation, by a proper chain of events which substantiate that whatever is being done has a commercial rationale, is justified, and is best for the business. Now, coming back to the TP methods, an important question which arises is that which method will be selected as the most appropriate method. Now, for the purpose of selecting the most appropriate method, the guide provides that taxpayers should consider the nature of transactions, functional analysis, availability of reliable comparable information, degree of comparability of controlled transactions and uncontrolled transactions, etc. The guide provides that the FTA's preferred approach is for TP methods to be applied at the respective transaction level where possible. The guide provides that the taxpayer may opt to apply the TNMM or any other method on a company-wide basis to corroborate or to substantiate the results obtained from the separate analysis performed on a transactional basis. Further, there may be situations where the activities or the transactions are sufficiently interlinked from a commercial and economic standpoint, and in those cases, it may be possible to rely on an analysis where the taxpayer aggregates the transactions by adopting a company-wide analysis to test the arm's length nature of the controlled transactions. Now, coming to another important aspect, which is what documentation, transfer pricing documentation is required to be maintained as per the corporate tax law or the TP regime in UAE. So the requirements are contained in Article 55 of the Federal Decree. So the main requirements are, it says that there should be a form with the tax return. So all taxpayers undertaking controlled transactions which are above a materiality threshold which has yet not been prescribed are required to prepare and submit this form alongside their tax return, which is within 9 months from the end of the relevant tax period. So we are expecting that the form will be available in due course on the FTA's website, and it is expected to include information such as the nature of the controlled transactions, their value, details of related parties or connected persons, and the TP method used to determine the arm's length price. There's a requirement for a master file. The master file provides a high-level overview of the group's business and the allocation of income and economic activity within a group, which primarily includes organization structure, description of business, intangible, intercompany financial arrangements and financial positions, etc. Then the local file or the transfer pricing documentation or the transfer pricing report. So the TP study report, it identifies the transactions with related parties or connected persons. This is essentially the crux of the transfer pricing exercise. So this has a detailed description of the transactions, the functional analysis. It has an industry overview, economic or benchmarking analysis. Benchmarking analysis essentially involves determining whether the transaction is at an arm's length or not. It involves financial analysis and use of appropriate databases for identifying the comparables. The local file compliance, it applies to large business as set out in the ministerial decision number 97 of 2023. And the taxpayer may provide cross-references to the information contained in the master file. Now coming to CBCR or the country by country report. So the UAE has introduced CBCR requirements through the Cabinet Resolution number 44 of 2020. So CBCR requirements are applicable to the UAE headquartered MNC groups with financial reporting years starting on or after January 1st, 2019. However, CBCR requirements are applicable to very large MNCs with a total consolidated revenue that is equal to or more than AED 315 million for the financial year preceding the reporting year concerned. Now, coming to the key takeaways for the taxpayers with respect to transfer pricing documentation. So it is important to note that while there are certain categories of transactions which are not required to be documented in a local file, those control transactions should be undertaken on an arm's length basis. So overall, taxpayers are required to maintain appropriate supporting documents to justify the arm's length nature of the control transactions, even though the prescribed threshold conditions to maintain TP documentation is not met. So the FTA may request the taxpayer to provide additional supporting documentation, which may include information to support the arm's length nature of the transaction, information considered for the application of TP method, or any other information deemed necessary by the FTA to support the arm's length nature, the controlled transactions when requested. So the FTA expects that documentation is maintained either at the time of the controlled transactions or by the time the taxpayers submit their tax return for the relevant tax period. Now, moving on, there are certain specific guidance provided for certain specified transactions in the TP guide. This is also in line with the OECD transfer pricing guidelines. So, for example, guidance has been provided with respect to financial transactions, intra-group services, intangibles, etc. With respect to financial transactions, immediate steps should be undertaken to put in place an appropriate pricing mechanism which aligns with the arm's length principles for both existing and future financial transactions. Taxpayers should ensure that the outstanding balance on account of controlled transactions are settled within a reasonable time, and the credit policy for controlled transactions is in line with what is offered in third-party contracts. For intra-group services, the benefits test has to be satisfied, which is determined by evaluating whether independent parties in comparable circumstances would have been willing to pay for the activity if performed by an independent service provider or would have performed the activity in-house. So the guide elaborates on the various aspects required to be considered, like shareholder activities, treatment of pass-through costs, reimbursement of expenses, duplication of activities, incidental benefits, and use of appropriate allocation keys, etc., to arrive at the cost base. With respect to intangibles, the taxpayers should undertake appropriate pay analysis to identify any intangible existing within the group for which appropriate remuneration should be charged. In cases where taxpayers are evaluating the option to undertake business restructuring within the group, it will be important for them to evaluate the TP implications and take appropriate steps to ensure that the appropriate documents, workings are maintained to support the arm's length remuneration of such transactions. So in case you are interested to know more on these concepts of intangibles, pay analysis, transfer pricing in business restructuring, please put in a comment below the video. I will prepare another video and shortly upload it if there is enough people who want a video on that. Now coming to last uh, few slides. So um, now coming to a transfer pricing policy. So a transfer pricing policy is essentially a pre-facto analysis. This document is prepared in advance of the international transactions to determine that what is the arm's length compensation expected from a transaction. This helps in structuring the business which will comply with the transfer pricing requirements. So our transfer pricing policy will identify the transactions with related parties or connected persons. It will have a detailed description of the transactions and their functional analysis, economic or benchmarking analysis. A transfer pricing policy will lay down the multinational's policy regarding the application and implementation of transfer pricing rules and help the tax and the finance department to ensure correct pricing. So it is important for taxpayers to revisit their existing TP policies and take appropriate steps to align them with the arm's length principle. In cases where taxpayers do not have a TP policy for the controlled transactions, it is imperative to undertake analysis to put in place an appropriate TP policy. The taxpayers should also put in place the mechanism to prepare and maintain comprehensive TP documentation backed by additional supporting information to demonstrate the arm's length nature of the controlled transactions. Now, what are the main action points of this whole presentation? Essentially is that the taxpayers, they should start the groundwork for implementation of transfer pricing. They should review the intercompany arrangements that they have. They should determine the related parties and connected persons. They should determine the transactions, the international transactions, which will have transfer pricing implications. And they should prepare a transfer pricing policy to ensure the intercompany transactions will meet the arm's length standard. Thank you so much for watching this transfer pricing UAE session. And I hope it was useful to all of you. I would love to hear your comments in the comments section below. And in case you want to reach out to me, you can always email at bbgtaxlaws@gmail.com. Thank you so much.